The past year has been a tumultuous one for global financial markets, prompting a significant reevaluation of what truly constitutes a safe haven currency. Traditionally, the US dollar, Swiss franc, and Japanese yen have been the go-to assets for investors seeking refuge during periods of economic or geopolitical instability. However, a volatile 2025 to 2026 has led many to question whether these long-held assumptions still hold true. The Japanese yen, JPY, once considered a top-tier safe haven due to Japan's stable economy and net creditor status, has seen its reliability challenged. While it has recently gained strength amid rising global risk aversion and speculation about the Bank of Japan tightening its ultra-dovish policies, the yen experienced significant weakness throughout 2025. This vulnerability stems from Japan's economic fundamentals, including high public debt and vulnerability to global supply chain disruptions, making its safe haven status less consistent than in previous decades. The Swiss franc, CHF, known for Switzerland's political neutrality, robust banking sector, and strong economic fundamentals, has emerged as a particularly strong performer in the current climate. It has surged against major currencies, including the US dollar, with many analysts now calling it the true safe haven. Investors are flocking to the franc as capital rotates away from US assets amidst fears of prolonged stagflation and geopolitical uncertainties. Unlike in past years, the Swiss National Bank, SNB, has maintained a neutral stance, signaling comfort with the franc's strength as a check against imported inflation, further boosting its appeal. Meanwhile, the US dollar, USD, while still holding immense global significance as the world's primary reserve currency, has faced increasing scrutiny regarding its safe haven credentials. Policy volatility, particularly under the Trump administration's Sell America trade approach with its tariff swings and doubts about the Federal Reserve's independence, have led some experts to suggest the dollar's safe haven myth is crumbling. While the dollar saw a brief surge in Q1 2025, that momentum reversed as the Fed signaled tighter monetary policy. Despite its deep liquidity and the inherent demand for U.S. Treasuries during crises, capital is increasingly rotating out of U.S. assets towards currencies perceived as more stable and predictable, especially during heightened trade tensions and domestic political gridlock.